Hello friends, welcome to Accounting Standard 15 now. So let us solve question number 15. Let us solve question number 15. AJ Limited is engaged in the business of trading of chemicals, having a net worth of 150 crore. The company's profitability is good and the company has introduced various benefits for its employees to keep them motivated. The company is an associate of RJ Limited, which is listed on the stock exchange. The company initially did not have any HR function, but over the last 2 years, the management set up that function, and now HR department takes care of all the benefits relating to employees and how they can be structured in a more beneficial manner and the objectives of the company. The first two paragraphs are useless, waste of time and talent of human being. Is it right? Because that is nothing to do with Accounting Standard 15. The real question starts now. One of the employee benefit scheme involves a lump sum payment to employees on termination of service, and that is equal to 1% of final salary for each year of service. So lump sum amount is paid on termination of service, and the amount is 1% of final salary. Consider the salary in year 1 is 10,000 and is assumed to increase at 7% compound each year. Taking a discount rate of 10% per year, you are required to show benefits attributed year on year, that is how much is the allocated benefit, and the obligation in respect of this benefit year on year. So we have to compute current service cost, we'll have to compute interest cost, we have to compute present value of DBO. The same thing we have done earlier also, and now the question says the employee is expected to leave at the end of year 5. The employee is expected to leave at the end of year 5. So we have paid him 10,000 rupees in the first year. This is year 1. He will retire or leave at the end of year 5. So the salary will appreciate by 10% for 4 years. So his last drawn salary will be 10,000 into 1.10 to the power 4. Salary in the first year is 10,000. 10% appreciation, 10% appreciation, 10% appreciation, 10% appreciation. So total is, we have to find salary last drawn multiplied by 1% and then multiplied by 5 years. That will give you total benefits to be paid. That you divide by 5 will give you benefits per annum. Following assumptions may be taken to solve this. There are no changes in the actuarial assumption. Actuarial assumption remains same for all the 5 years. At intermediate level, they are not going to ask questions where the actuarial assumption will change after some point of time, because then the question will become a little more complicated. So in all your question at intermediate level, we are going to keep actuarial assumption constant. Is it right? We are going to keep actuarial assumption constant, which means the employee will retire after 5 years, discount rate will remain 10%, salary growth will be 7%. I have written by mistake 10, it should be salary growth is 7%. Okay, salary growth is 7%. No additional adjustments are needed to reflect the probability that employee may leave the entity on an earlier date. So the question is very easy. Can you believe that? Question is very easy. So write down step 1, calculation of expected benefit. His salary right now is 10,000. In year 2 it will increase 10%. Year 3 it will increase 10%. Year 4 it will increase 10%. Year 5 it will increase 10%. So the answer is expected benefit will be, first you compute last drawn salary, 10,000 into 1.07, sorry, again I made the same, 7% will be growth rate, will be for 4 years, into 1% of the last drawn salary and into number of years of service. Very important. Anybody please reply what is the answer? What is the answer please? What is the answer of this calculation? So this comes to last salary is 13108 into 1% into 5 years. So that comes to 655, rounded off. We will round off. This is the amount payable after 5 years. He will serve for 5 years. So per year the benefit will be allocated as follows. Step 2, calculation of allocated benefit. 655 divided by 5 is 131 rupees. So he will get 131 rupees for rendering services for each year. He will render service in year 1, he'll be entitled to 131 rupees. So total amount he will get at the end of year 5 will be 655. Total he will get at the end of year 5 will be 655. But now there is a small issue. The amount will not be paid to him today. The amount will be paid to him at the end of the 5th year. But we will have to do the accounting at the end of year 1, at the end of year 2, at the end of year 3, at the end of year 4 and 5. So I need to compute present value. I need to compute present value of 131 received in the 5th year but accrued at the end of 1st year. So that will be equal to, you can try 131 divided by 1.10 to the power 4. Okay, this 131 will accrue at the end of year 5, will be received at the end of year 5, but will be due at the end of year 2. So the gap is 3 years. We'll have to discount it. This 131 will be received at the end of year 3, will be received at the end of year 5, accrued at the end of year 3. So as per the standard, we'll have to discount by 2 years. This 131 accrued in the 4th year, received in the 5th year. So there is a gap of 1 year. So this will be discounted by 1 year factor, and this 131 no need to discount. It is accrued and received at the end of 5th year. So we'll have to find out current service cost. This calculation I have written are current service cost for year 1, 2, 3, 4 and 5. If you can understand this much, then you have understood this chapter. Remaining part of the chapter is otherwise very easy. So please write down step 3, calculation of current service cost. Under that, year 1, 2, 3, 4, 5, allocated benefit is 131 5 times. And now what the student will do? The student will take 131 divided by 1.10 to the power 4, and that is equal to 89. I have explained to you again. I will explain again. Accrued at the end of year 1. but will be received at the end of year 5. So there is a gap of 4 years. Now you try 131 divide by 1.10 to the power 3, and that is equal to 98. 131 divide by 1.10 to the power 2, that will come to 108. 131 divide by 1.10 to the power 1, 119, and the last one no need to discount, the last one will remain same. So that is 131. So this is called current service cost. This is called current service cost. The increase in liability because the employee has rendered service for 1 year. Now the next is, we'll prepare a liability sheet. This time we don't have to pass journal entry, not required as per the question. So what I'll do, I will prepare a liability sheet, which is nothing but which will give you the amount to be recognized in P&L account and in balance sheet every year. So you will write a liability sheet like this. There are total 5 years, year 1, 2, 3, 4, 5. Opening balance of the liability, current service cost, interest cost, and closing balance. Opening balance, current service cost we are going to get from, you write in bracket step 3. Current service we are going to get from step 3. Interest cost will be write down. Interest cost will be opening balance multiplied by 10%. Opening balance A multiplied by 10%, and closing balance will be A plus B plus C. Closing balance will be A plus B plus C. First year opening balance of liability is 0. Of course, there is no opening balance because it is the first year, and then we are going to calculate current service cost done in the step number 389. If there is no opening balance in the first year, interest will be 0, and my closing balance will be A plus B plus C. 0 plus 89 plus 0, and that comes to 89. This 89 becomes next year opening balance here. Current service cost step number 3, 98. On 89, interest at 10%. On 89, interest at 10%. So that is 9. Take the total, that is my closing liability in the balance sheet. This closing balance will be shown in balance sheet. Try the third year. Opening balance 196. Current service cost step 3, third year, previous step 108. Interest on opening balance 196 into 10%. I am rounding off. You can write in decimals if you want, 20, and then we have total 324. Total 324. Opening balance next year. Fourth year current service cost was how much? Fourth year current service cost, refer the above table, 119. 119 on 324, 10% interest, round off 32, and therefore closing balance is 475. 475 opening balance. Current service cost step 3 above table 131. Interest cost in the last year is the balancing figure, very important, because my total amount to be paid to employee 655. To make the total closing balance 655, make the interest in the last year as a balancing figure. So that is 49. So this is my liability sheet. They have not asked you to pass journal entry. If they ask you to pass journal entry, then what will be the entry in year 1? Year 1. Year 1 entry will be current service cost account debit this figure. 89 to present value of defined benefit obligation 89. Year 2 journal entry will be current service cost account debit 98. Good students will write, other students will enjoy now but suffer later, because they can ask you journal entry. In the previous question number 15 we have seen they had asked you to compute journal entry, previous problem which we did in the previous lecture, to present value of DBO total 107. Year 3 current service cost account debit, if they ask you to pass journal entry, this 108. Interest cost account debit 20, this 20, to present value of DBO 128, and that way you will pass entry in the 4th and 5th year also. So homework, pass entry in the 4th year and pass entry in the 5th year. Right? Current service cost and interest cost will be transferred to P&L account, and present value of defined benefit obligation will appear in the balance sheet as a liability. For the financial statement extract presentation, please refer the previous question. Please refer the previous question where we have given how to present in the P&L account and how to present in the balance sheet. So another homework, write down, another homework for the same question, presentation in financial statements, that is balance sheet and profit and loss account. Presentation in financial statement. So this is my question number 15. Now we'll come to question number 16. Write down, very, very important. This question has been taken from reference book. It was asked in past exam also. So please note down there, past exam question. Okay, very important, because past exam questions are more likely to be repeated in the exam. An employee Roshan has joined a company XYZ. In the year 2018, the annual emoluments of Roshan is decided as 14,90,210. So much salary, okay, per annum 14,90,210. If you come in merit in CA final, then you will also become Roshan. The company has also a policy of giving a lump sum payment of 25% of last drawn annual salary, already discussed in the same previous problem. This time it is 25% of last drawn salary of the employee, underline again, for each completed year of service. So this time he will get 25% of last drawn salary for each completed year of service if the employee retires after completing minimum 5 years of service. Please underline minimum 5 years of service. The employee will have to first complete 5 years of service. The employee has to first complete 5 years of service, then only he will be entitled to this benefit of 25%. Okay, salary of Roshan is expected to grow at the rate 10% per annum. So the problem is similar to the previous one, figures are different. Okay, same problem, but figures are slightly different. But don't treat it lightly, because there is a small difference also. The company has inducted Roshan in the beginning of the year, and it is expected that he will complete the minimum 5-year term before retiring. Underline again, he will complete minimum 5-year term before retiring. What is the amount the company should charge in the P&L account every year as a cost of defined benefit obligation? Also calculate the current service cost and interest cost to be charged per year, assuming a discount rate of 8%. And your kind institute, your lovable institute has given you present value factor also. Okay, so you can check the present value factor. This is 1 divided by 1.08 to the power 4. This is 1 divided by 1.08 to the power 3. 1 divided by 1.08 to the power 2. 1 divided by 1.08 to the power 1, and this is 1. So you don't have to compute the present value factor. First year current service cost, you will use this factor. Second year you use this factor. For third year you use this factor. For fourth year you use this factor, and for fifth year you will use this factor. So factors have been given on a plate. Gup, enjoy. Okay, now my question to all of you, the highly qualified and talented student, is what will be the last drawn salary? Now understand, year 1, 2, 3, 4, 5. So Mr. Roshan has to complete 5 years. Minimum 5 years of service, underline. Minimum 5 years of service, underline. 2 times they have repeated. After completing 5 years, he will enter into the 6th year, because he has to complete 5 years and then go into the next year, and then he will be entitled to the benefit. So today his salary is 14,90,210 in the year 1. It will grow at the rate 10%. So 10% year 2, 10% in year 3, 10% in year 4, 10% in year 5. Up to this is same, but this time he has to complete a minimum 5 years of service. After completing 5 years of service, he will enter into the 6th year. The moment he enters into the 6th year, we are going to further increase the salary by 10%. So this time the salary will appreciate by 5 times. First he will complete 5 years, then he will enter into the 6th year. The moment he enters into the 6th year, there will be another salary increase of 10%. So this time the problem requires you to calculate the last drawn salary by appreciating it by 5 years, not by 4 years like the previous 2 problems. That is the only difference in this question number 16 and 15 number. Okay, so now the student will write calculation of expected salary at the time of retirement. So his salary at the time of joining is this. He will have to complete a minimum 5 years of service. So power will be 5. Calculate and write down, or I have written the answer in your notes. As a homework you will solve in the notebook. Right now only concentrate on understanding part. As a homework, close the book, only keep the question open and try to solve yourself. First compute last drawn salary, or the salary expected at the time of retirement. That comes to 24 lakh. He has to complete 5 years of service. Calculation of expected benefit 24 lakh. He will get 25% of last drawn salary, and he has to complete 5 years of service, minimum 5 years of service. So the total benefit expected to be paid to Roshan, calculate 24 lakh into 25% into 5 years, that comes to 30 lakh. Now this 30 lakh divided by 5 years, so that we will call allocated benefit. Benefits per annum. Benefit payable to Roshan for rendering service for 1 year. 1 year service is equivalent to 6 lakh rupees benefit payable to him at the end of year 5. Now some student can get confused why we have taken the power 5. That can be a query. So before you ask that query, read this note below. Read this note below. Take a pencil and connect this. That why we have taken the power 5. Assumption is the employee will retire on 1/4/2023. Hence the salary will increase by 10% for 5 years. The employee has to complete a minimum 5 year of service. Now what the student will do? He is confused now. Should I take 4 year or 5 year? If the problem uses the term that the employee has to complete a minimum 5 year of service, then take the power 5. If the problem says the employee will retire at the end of year 5, if it is end of year 5, then you will take the power 4. Then you will take the power 4. For exam purpose, keep that in mind. Now we are going to compute current service cost. Each year of service rendered in 4,41,000. Again try. 0.794 given. Don't apply your own factor now. Institute is helping you. 4,76,400. Then 0.857. Factors are given in the booklet. Please copy the factors from there. Multiply. Take the total. Multiply. Don't take total. Total not required because these are individual years. Total not required. These are the current service cost. These are the current service cost. But in addition to current service cost, we have to also compute the interest cost. The reason is the total amount payable to employee would be 30 lakh, and what you have calculated is not coming to 30 lakh, it is much lower than that. The difference between this total and the 30 lakh you have to pay is interest. So we have to also compute the interest amount. For that, we are going to prepare one liability sheet. So come to the liability sheet. We have 5 years. Same format I am keeping to avoid any confusion. Opening balance of the liability. You can mention their opening balance of liability. Current service cost. Opening balance of liability, in case if you are having any doubt. Current service cost, write down in bracket step 4. This we are getting step 4. Interest cost you write down if you want. It is opening balance multiplied by 8%, which is the discount rate, and closing balance write down A plus B plus C. Closing balance goes to balance sheet. Current service cost and interest cost goes to profit and loss account. So let us quickly try. Opening balance year 10. Current service cost 4,41,000 from the previous step, last column. First year interest is 0. Total 4,41,000. Closing balance becomes opening balance next year. Step number 4, current service cost 4,76,400. Take opening balance multiplied by 8%, you will get 35,280. Please check. 35,280. 35,280. Take the total. 952,680. Year 3, 952,680. Current service cost. Step number 4, last column. 5,14,200. Please check the answer. Now multiply 950 to 680 into 8%. You will get interest 76,214, and then the closing balance is 1543,094. Interest is calculated because we have recorded the current service cost, which is present value of the amount payable. So on maturity, my book value of liabilities should be equal to 30 lakh. So every year the interest has to be accrued and provided for. Continue the good work. 15,43,094, current service cost, step number 4, opening balance into 8%, 123,447, closing balance, take the total. Closing balance, take the total. Fifth year, do yourself. Fifth year, you will do yourself. Fifth year, you will do yourself. Now check the answer. Check the answer. In the fifth year, what you do? The interest will become balancing figure. As the total amount payable to Roshan is 30 lakhs. So if there is a difference of 1 rupee, 2 rupees, 3 rupees, 4 rupees, please adjust in the interest part. This question requires you to also explain how much amount will be charged in P&L account. The amount that will be charged in P&L account will be current service cost and interest cost. So these two figures I am going to write in P&L account, and also I am going to take the total. Ready? So the last part of the answer is presentation in the P&L account, which we have already discussed in question number 14, and in question number 15 I have given as homework. So P&L account will have two items: current service cost. You can copy current service cost from step number 4, in bracket write step number 4, and you can copy interest cost from step number 5, interest cost from step number 5, interest cost from step number 5. So total amount to be charged, total amount to be charged to P&L account A plus B. Check yourself whether the total is right. First year 4,41,000, second year 5,11,680, third year 5,90,414, fourth year 679,047, and fifth year 779,859. This is how P&L account will be presented. Write one homework here. Homework: presentation in balance sheet. Presentation in balance sheet. In balance sheet, closing balance will appear every year. Closing balance. And write homework number 2, past journal entries. These are the questions they can ask you in the exam. Journal entry, balance sheet part, P&L account extract part. Okay. Current service cost calculation, interest cost calculation. At your level, this is what is expected in the exam. In order to avoid any future confusion, some notes are written below for your understanding, because this question creates confusion. If the question would have mentioned that employee will retire at the end of 5th year, underline at the end of 5th year, then I will take 14,90,210 into 1.10 to the power 4. However, the question says employee will require to complete a minimum 5 year of service. Again underline minimum 5 year. In that case, we will take 1490,210 into 1.10 to the power 5. So this was a very important question for your upcoming exam, and you must do it. So these are the 3 questions I have taken on defined benefit obligation. Keeping examination requirement in mind, I think these 3 questions would be good enough. Let us come to the presentation in the balance sheet. How much amount will appear in the balance sheet? Students are requested to concentrate because this is the little technical part. You may or may not understand it at the beginning, but later on as we go ahead, you will understand. Okay. This standard AS15 is supposed to be one of the most complicated accounting standards issued in India, one of the most complicated accounting standards, because it requires a lot of technical understanding of actuarial valuation. Similar accounting is not taught in your normal accounting classes. Hence, the students may find it a bit difficult in the beginning, but don't worry. We will try to simplify. Have you understood current service cost, interest cost, present value of defined benefit obligation? That's it. And some more thing we have to learn, and then it is over. So, how much liability will appear in the balance sheet? How much liability will appear in the balance sheet? That is the question. And how the liability will be presented in the balance sheet? In the balance sheet of the enterprise, the amount recognized as a defined benefit liability, that is the liability amount, should be net total of the following amount. Underline the word net total. Net total means you have to take the net of 3 numbers. First is compute the present value of the defined benefit obligation at the balance sheet date. Present value of the defined benefit obligation, that is what we have learned to compute, or in short, the liability amount, which the actuary will tell you that this is your liability at the end of the year. The actuary will give you the number, but you are a student, so institute will give you the number, and you have to see what is your liability at the end of the year. Okay. That is technically called present value of defined benefit obligation, or the liability under defined benefit plan. Second, you will deduct, underline the word minus, deduct any past service cost not yet recognized. What is the meaning of this? Deduct any past service cost not yet recognized. Deduct past service cost not yet recognized. Let us understand, and this will be explained in a separate paragraph also. What is past service cost? Suppose the employee has already rendered, let us say, 3 years of service. Briefly understand, employee has already rendered 3 years of service, and then suddenly the company changes the defined benefit plan. Earlier, company had agreed to pay 1% of last drawn salary. Now, the company and the employee agrees that the gratuity should be not 1% but 2% of last drawn salary. So because of that, we need to recalculate the liability. We need to recalculate the liability because earlier calculation was based on 1% of last drawn salary, but now it has to be 2% of the last drawn salary. So in our book, at the end of year 3, we already have some liability. we already have got some liability, and that liability needs to be amended or increased or decreased. So this increase in the liability due to change in the plan from retrospective effect, increase or decrease in liability due to amendment in the plan from retrospective effect, is called past service cost. So first thing you have to understand, past service cost means he has already rendered service in the past year. Earlier we have recognized the liability using 1%, but now management and employee, they have renegotiated and it is 2% of the last drawn salary. So the service which have already been given in the past, the liability with respect to that needs to be amended. It may increase, it may decrease. It may increase, like in this example, 1% to 2%, but the management may say we will give you only 0.5%. Then in that case the liability can decrease also. So I need to provide for that. That is past service cost. Past service cost is of two types. Past service cost is of two types. Which two types? Past service cost is of two types. You don't have to write, it is written on the next page. I am just explaining. One is called vested, one is called unvested. Vested means conditions already fulfilled. Vested means conditions already fulfilled by employee. Like condition is that the employee has to complete a minimum 5 years of service. He has completed. So past service cost with respect to such employee who have fulfilled the condition is vested. Unvested, conditions not yet fulfilled. Conditions not yet fulfilled. Condition is to complete minimum 5 years of service. There are some employees who have completed 3 years only. So with respect to such employee, 2 more years they have to serve. Then they are entitled. Then they will be entitled for the benefits. Then they will get the benefits. So as per the standard, if the benefits have been vested, then it is transferred to P&L account. It is transferred to P&L account, so it is recognized in P&L account. But benefits which are unvested, it is not recognized in P&L account. It is not recognized, it is deferred. It is deferred. It is not recognized in P&L account, it is deferred. Since it is deferred, it will appear in the balance sheet because the figure is still there in the trial balance. Journal entries deferred, PSC, past service cost, to PV of DBO. So we have passed the entry, but it is not transferred to P&L account. It is still appearing in the balance sheet. It is still appearing in the trial balance, because in trial balance debit column you will have one item, deferred past service cost. What do I do with that? So the standard says this will be shown as a deduction from the liability. This will be shown as a deduction from the liability. So liability, point number A, minus deferred past service cost, minus deferred past service cost, and point number C, minus the fair value at the balance sheet date of plan asset, if any, out of which obligations are to be settled directly. This is nothing but any investment made to settle the liability. Technically they call it plan asset in the standard. Common man will say investments made. Okay, so that when the employee will retire, this investment can be used to settle the liability. So my answer is the liability amount will be taken, from that you deduct deferred past service cost, point number B, and deduct plan asset, fair value of plan asset. Fair value means market value. Plan asset means investment that you made. So let us call it A, B, C, and in the balance sheet you are going to present A minus B minus C. You are going to present A minus B minus C. That is called presentation of liability in the balance sheet. I will repeat, PV of defined benefit obligation minus any deferred past service cost minus fair value of plan asset. Okay, now see the formula again. There is a problem with this formula. What is the problem? Let us see. The answer can be negative sometime. For example, liability is 20, deferred past service cost is 10, let us say 10, and you have made investment which is equal to 120. So my net liability will be now 3030. Liability is negative. The reason is the fair value of the plan asset is more than the liability. You have invested more. So then instead of showing it on the liability side, if you are getting the total as a negative amount, where I am going to show it? I am going to show it on the asset side as 30. So that sometime this can happen. Sometime it can happen that the liability minus deferred past service cost minus fair value of plan asset can be negative, then it will be presented on the asset side. It will give rise to net asset. Okay, but there is a limit. There is a limit. What is the limit? How much maximum asset you can disclose in the balance sheet? The maximum value of plan asset you can disclose in the balance sheet is lower of the two. Again, prudence is applied. Concept of conservatism. You will be presenting asset, but you have to apply the prudence. It is lower of the two. Amount so determined. In our example, 100 minus 10 minus 120 minus 30. So amount so determined is 30. But because it is an asset, we have to check its recoverability also. We have to check whether this asset will give me a benefit of 30 or more. How much benefit will I get? Minus, and second item, present value of any economic benefit available in the form of refund from the plan or reduction in future contribution to the plan. You have made surplus investment. So you have to see, suppose I want to get the refund. Can I get the refund? Yes. Suppose I can use this surplus money to reduce my future contribution. Can I do that? Yes. So find out what will be the present value or economic benefit either in the form of refund or in the form of adjustment against future contribution payable. If suppose that amount comes to 50, then it is okay. You can show 30 as an asset. If the asset recoverable is more than 30, then I am going to present 30 on the asset side. But you have made additional investment and the recovery can only be, let us say, 15. The recovery can only be 15. That means in future either you will get a refund or a reduction in contribution to the extent of 15 only. So let us call it, simply put, recovery. You have given me 30 rupees extra, but I will only refund you 15 rupees. So what is the worth of this asset now? 15. Because you will get a recovery of only 15, I will take lower of these two, 15. Difference between 30 and 15 recovery will be transferred to profit and loss account. So extra amount will be written off in P&L account. Extra amount will be recorded in P&L account as an expense. Logic is simple. If you have an asset of 30 but you can recover only 15 out of it, you have to write off the balance amount. Like suppose you have a debtor, you have to recover 30 rupees but he is going to pay only 15 rupees. So you are going to only keep 15 in the books, 15 is written off. Suppose you have inventory of 30 rupees but you are going to only realize 15 rupees by selling that inventory. What do? I keep only 15, remaining 15 I write off. Using same prudence, they are saying that plan asset cannot be more than the amount in the form of recovery of refund or the reduction in future contribution. So that is the idea. If the amount in A1 is more than the amount in 2, the difference will be transferred to profit and loss account. So this is about balance sheet. Balance sheet, remember 3 numbers. Liability will be equal to PV of DBO minus deferred past service cost minus fair value of plan asset. This net amount will appear in the balance sheet. If net is positive, we are going to show on the asset side lower of the two, amount computed here and the recovery, whichever is lower. Come to P&L account. Now P&L account has total 7 components with respect to defined benefit plan. Oh my God, how many components? 7 components. We have seen 4 of them till now. We have seen current service cost, we have seen interest cost, we have seen past service cost, and we have seen write-off of plan asset in the last discussion of balance sheet. These 2 we have discussed in the discussion of balance sheet. In addition to that, there are few more items, 3 more items which will be shown in profit and loss account. So which are these items? Let us make a list. Current service cost we have discussed 3 questions. Interest cost we have discussed, we have taken 3 questions. Point number C is expected return on any plan asset and any reimbursement right. Now what is this item? We have to explain this also. If you have made investment in plan asset, that is the funds that you have invested for settlement of employees due, that fund will generate some income. If you have invested in some sinking fund, don't you think they will generate some income? So you are going to record here expected return on plan asset also. Okay, if the company has used funding for settlement of liability, that means you have created investment in the form of either insurance policy or investment in trust or your own trust. It is expected to generate some return. Consider that also in the P&L account. Next is actuarial gains and losses. Actuarial gains and losses means gain and loss arise due to change in actuarial assumption. Gain and loss arising due to change in actuarial assumption, or gain or loss arising due to difference between actual outcome and expected outcome. So for 2 reasons there can be gain or loss. One is due to change in assumption. If the assumption changes, the liability will change, that is actuarial gain or loss, or due to difference between actual outcome, because actuary has made the assumption, and expected outcome. What actuary was assuming and what actually happened can be different. For example, actuary will assume expected return on plan asset as 12%, that is expected 12%, but actual may be 11% only. So that will result into actuarial loss, where we will transfer actuarial gain and loss P&L account. Past service cost, to the extent they are recognized, means to the extent they are vested. Past service cost I have explained. Change in the liability due to amendment in a plan. From 1% of last drawn salary, you can make it 2%. Point number F, effect of any curtailment or settlement. Sir, what is curtailment? Curtailment means reduction in benefit. If an employer says, see, these are my divisions, these are my business unit, we are planning to close it down because there is no business. So now henceforth the employees of that division will not receive the benefit. So that is curtailment. Benefits are reduced because probably some division, some department, some branch have been closed. Or settlement. Sir, what is settlement? Settlement means making a lump sum payment. Suppose the employee is retiring. Employee is retiring. You have to pay him pension, 10,000 rupees per month till he will survive. Instead of paying that, the company tells the employee, we will pay you 50 lakhs, but then we are not going to pay you the pension. Employee also feels happy. Oh, I am getting 50 lakh immediately. And when you see a big amount, you will be very happy. And therefore, it is called settlement. Because you have settled that liability once for all. Final handshake, tata bye bye, don't show your face from tomorrow. We have paid all dues to you by making one lump sum payment. So settlement. But that settlement will also result into gain or loss. Transfer to P&L account. Curtailment may result into gain or loss. Transfer to P&L account. Past service cost may result into gain or loss. Transfer to P&L account. And this point number G, already discussed. The extent to which negative net amount of defined benefit liability exceeds the amount mentioned in paragraph 59B of the standard. What is this? I will again explain. Suppose your present value of defined benefit obligation is 100 minus deferred past service cost 10 minus fair value of plan asset is 120. So we are getting a negative 30, but the recovery of plan asset possible is only 15. Now you see the extent to which negative net amount, that is 30, exceeds the amount mentioned in para 59B, means recovery. This difference between 30 and 15, amount you got as negative balance, amount that you can keep in the books is equal to maximum recovery will be transferred to P&L account 15. So this is my these are my 7 components in P&L account. Okay. Now I am going to tell you something interesting. Current service cost is always an expense. Interest is always an expense. Expected return on plan asset always an income because it's a return gain. Actuarial gain or loss can be plus or minus because if it is gain, it is an income. If it is a loss, it's an expense. Past service cost can be plus or minus. If your liability increases, it is your expense. If your liability decreases, it is an income. Then current service cost, effect of curtailment or settlement can be gain, can be loss. Can be gain, can be loss, and this is always loss. This is always loss. So minus sign means loss, plus sign means gain. So this is, if you want, you can write. This will not be explained in your study module or any other notes. Okay, the net total of these 7 items is presented in the profit and loss account as employee benefit cost under defined benefit obligation. Okay, now we are going to take one question after so many minutes. Question number 17. Following information relates to a defined benefit plan. So first you underline defined benefit plan. Source is a reference book. Your study material does not have enough question, but they will ask you in the exam. Don't think your study material is enough for accounting standard. You need to practice more. Fair value of the plan asset is 950. Present value of the defined benefit obligation pension liability is 800, and recovery, that is present value of future refund and reduction in contribution, 70. What is the value of the asset that is recognized in the financial statement? What is the value of the asset that will be recognized in the financial statement? So first you see present value of liability, start like this, is 800 minus deferred past service cost, not given, ignore, minus fair value of plan asset is 950. So I am getting a total of 150. I am getting a total of 150. And what is the present value of future refund and reduction, etc.? 70. Okay. Therefore, amount to be shown in balance sheet, that is asset side, will be lower of 150 and 70, and that is equal to 70. Amount to be written off in P&L account will be 150 minus 70 is equal to 80. Very, very important question. Sometimes the fair value of plan asset is more than liability. So should you show it as an asset 150? The answer is you have to also check what is the present value of refund and reduction in future contribution, which is only 70. So even though you have made 150 surplus payment, you are going to recover either in the form of refund or reduction in contribution only 70. Just think like this, you have given me 150, but I will return you only 70. So for you the recovery is only 70. What will you do with that? Keep 70 only in the balance sheet and remaining 80 is your loss. Transfer to profit and loss account. So a good student will also write this line in the notes because this is not printed. This was point number G in your above paragraph 21. The extent to which negative amount of defined benefit liability exceeds the amount mentioned in paragraph 59B of the standard. So this was the example on paragraph number 21 point number G. Paragraph number 21 point number G. Okay. So I have written the answer in your book. You can check. Homework. Solve in the notebook. Homework is solve in the notebook. Good student will follow the instruction of the teacher. Otherwise, you will just watch this show as if some show is going on. It will not help you. You have to write. Okay. Now come to the next question number. Where is the question? I will read question number 18 from your book. I will read question number 18 from your book. The question number 18 is also same. One more practice for you. How will the following information be presented in the balance sheet? PV of defined benefit obligation 2750, plan asset 2975, refund and reduction 175. 100% same problem. So what you should do in the exam, you will have to first write PV of DBO, which is 2750. Source is a reference book. Study material does not have such good questions. Less fair value of plan asset 2975. So therefore difference is 225. Can we call it as an asset in the balance sheet? The answer is no. The answer is no. First we'll have to see the recovery. Just make a small correction here. Write down here present value of future refund and reduction. Please write down, please correct it, and reduction in future contribution. And reduction in future contribution, that is given as 175. That is given as 175. Now tell me, will you keep in the balance sheet asset side 225 or will you keep 175? So you are going to keep lower of the two. So in balance sheet asset side we are going to present 175. And what about the difference? Note, write down. Note, write down below the answer. The difference between 225 and 175, that is 50 lakhs, will be, please write down, transferred to profit and loss account. Will be transferred to profit and loss account in bracket as per para 59B of AS 15. As per para 59B of AS 15. So this is my question on asset having a debit balance or liability having a negative balance. How much will you present in the balance sheet? Now the next concept is past service cost. Past service cost. Employer has promised to employee that I will give you 1% of last drawn salary. Okay, and they have started, employee started working, but after some year the demand for employee has increased. He has got so much of skill that other companies are trying to pull him He goes to his employer. He says, sorry, sir, I want to leave. I want to leave the firm. Employer says, why? Why do you want to leave? He says, others are offering me higher benefit and you are only offering me 1%. The employer thinks that, oh, he is a good employee. Let us give him a higher benefit, otherwise he may leave. And it is difficult to find such skilled and talented employee. So they said, don't worry, instead of 1%, we'll make it 3%. But he has already completed services in the past. 1, 2, 3, 4 years are over. And we have some liability here in the balance sheet, which was calculated using 1%. But now I have to revise my liability by doing the calculation at 3%. So my liability will change. Change in liability, because the plan has been amended. So there, and this 4 year of service he has already rendered. It is not for current year. This increase in liability is not due to current year service, it is due to service rendered in the past. So this change in liability is called past service cost. Is the change in the present value of the DBO for employee's service in the prior period, for the service rendered in the earlier period, resulting in the current period, but it has come in the current period. This change has been calculated in the current period from the introduction of, either you have introduced or you have changed a post-employment benefit plan or any other long-term employee benefit plan. So this additional liability is called past service cost. Now they have written one line, past service cost can be positive or past service cost can be negative also. Oh my God, the liability can increase also, the liability can decrease also. In this example, in the example on the screen, from 1% to 3%, the liability will increase. So it will be positive. But it is also possible, reverse possibility. Earlier we were paying him 3%. Earlier employer was paying to employee 3% of last drawn salary. But now there is a recession, there is a lockdown. Okay, company wants to reduce the cost. So this time the employer calls the employee, please come here. We don't need your services. Why? You are very expensive staff. You want so much benefit. I can't afford. Now the employee thinks, if I leave the job, I won't find another job. There is a lack of demand for employment. There is unemployment everywhere. So he says, sorry sir, I am willing to accept 1% of the last drawn salary. Don't worry, I am with you. I am with you in this difficult times. I can accept a lower salary. Okay. In that case, your liability will decrease. That is called negative, where existing benefits are reduced. So past service cost can be positive or negative. Now there are two types of past service cost. One is called wasted and one is called unvested. If the benefits have vested, sir, what is vested? I have already explained. Vested means conditions fulfilled. Condition required to get the benefit have been fulfilled. Example, only those employee will get benefit who have completed 5 years of service, and some employees have completed 5 years of service. So with respect to such employees, we will say the benefits have vested, past service cost have been vested. Vested past service cost will be fully transferred to P&L account, or there can be unvested, conditions not fulfilled. Example, employee has to complete 5 years of service. Some employee have completed 3 years of service. He has not completed 5 years, so he has to still serve 2 more years. So what we will do with respect to such employees, we are going to defer past service cost and recognize over the remaining period, means we are going to write off proportionately every year. So if 2 years are remaining, I will transfer 50% in each year to P&L account. If 4 years are remaining, I will transfer 1/4 every year to P&L account. That is called straight line basis. Till that time, deferred past service cost will appear in balance sheet as a deduction from the liability. Okay. So to make your life easier, I have made a quick summary. To the extent benefits are already vested, vested means condition fulfilled, due to introduction of a plan or due to change in the plan, then you will recognize immediately in the statement of profit and loss. Journal entry, past service cost account debit to liability for gratuity or any other post retirement benefit or any other long term benefit. Gratuity was only used as an example, and this past service cost will be recognized fully in P&L account. But if it is unvested, first I am going to defer it and then I am going to write it off over the remaining vesting period, just like you write off any expense over a period of time. So here the entry will be deferred past service cost account debit to liability for gratuity, or in case if your question says pension, write pension. If your question says other long term benefit, you write other long term benefit. Gratuity I have written only for the sake of example. And where will this deferred past service cost appear? The deferred past service cost will appear in the balance sheet as a deduction from liability, already explained at the time of balance sheet presentation. Where an enterprise reduces benefit, it is also possible during recession, lockdown, bad business environment, benefits may be reduced. The resulting reduction in the defined benefit liability is recognized as a past service cost over the average period until the reduced portion of the benefits become vested. Same treatment. Same treatment means reverse these two entries. Reverse the above two entries. In case if past service cost is negative, if the benefits have become vested, then pass the entry liability for gratuity account debit, to past service cost, and if the liabilities is not yet vested, pass the entry liability for gratuity debit to deferred past service cost. Now good news for you, the institute have never asked a question on negative past service cost. Never ever question have been asked on negative past service cost. The reason being, generally the liability increases, not decreases. But yes, we should be ready with the answer. Now we'll take a very important question on past service cost. You have to pay attention in understanding. Focus should be on the screen. These are the basic question expected for 4 to 5 marks in the exam. How will the following information be presented in the balance sheet of ASF Limited? PV of defined, this question we have done. It was written above. This is the question I am talking. very important. ASF Limited operates a pension plan that provides a pension of 2% of final salary for each year of service. The benefits become vested after 5 years of service. On 1st January, the enterprise improves the pension to 2.5%. Wow! Employee will be happy. This is employee. Now he is super happy because his benefit has increased from 2% to 2.5%. Okay. And this is the employer. Employer will be sad because he has to pay more. Because of this increase in the percentage, what will happen? Enterprise improves the pension to 2.5% of final salary for each year of service starting from 1st January 2001. And we are standing here on 1st January 2005. At the date of improvement, the present value of additional benefit for service from 1st January, just a minute, from 1st January to 1st January 2005 is as follows. Very easy question, subject to you understand it. What is the condition? Benefits become vested after 5 years of service. They have identified two types of employees. Category 1 employee who have completed more than 5 years of service, and the amount of liability, increase in liability with respect to these employees is 150. So can you give me the treatment of this? Can you give me the treatment of this? Please suggest me the treatment of this 150. It will be fully recognized in P&L account because these are vested benefits. Benefits have become vested, they have completed 5 years of service. And then we have employees with less than 5 years. You can write vested, you can write unvested. Vested fully P&L account. Now what about unvested? It will be deferred and recognized over the remaining vesting period. Average period until vesting is 3 years. So here 120 will be deferred and 120 divided by 3, 40 will be recognized each year over a period of 3 years. This is the answer. Answer is printed in the book, so I am not dictating. Show the accounting treatment. Show the accounting treatment. I hope you, the answer you have to write. Oh my God. So I'll dictate the answer. Please note down the answer. Some space is kept blank in your book so that you can write. So write down please. The enterprise recognizes rupees 150 immediately, because those benefits are already vested. Second line, the enterprise recognizes rupees 120 on a straight line basis over 3 years, from 1/1/2005, over 3 years from 1/1/2005, in bracket, that is rupees 40 per annum. that is rupees 40 per annum. Is it right now? So that was about past service cost. Same question is asked every time. You can do it. Now we'll come to settlement. Settlement means, as I told you, an employee is retiring. An employee is retiring. So option 1 is company pays rupees 10,000 per month till he survives or until he dies, you can say, whatever suits you, whichever language helps you to understand. And the other option is option 2, pay a lump sum amount and settle the liability. Okay, pay a lump sum amount and settle the liability. You tell the employee that, dear employee, we are willing to pay you a lump sum amount which will eliminate all my further legal or constructive obligation. Okay, either for part or whole of the benefits provided under a defined benefit plan. Suppose the employee agrees for this. Employer and employee will sign the agreement. A lump sum amount is paid, and now the employer is no longer required to pay him per month pension. So this is called commutation of pension. This is also called, for example, if it is a pension liability, commutation of pension. So the employee is benefited, he gets a lump sum amount. The employer is benefited, now he does not have to pay every month a certain amount. So that is called settlement. What is the treatment? The treatment is P&L account. Treatment, you can write here just one line. If it is not written, it's not written. Treatment, write down any gain or loss transfer to P&L account. That is the treatment. So this was also there in your 7 items in P&L account: curtailment and settlement. So if due to settlement there is any gain or loss, if your liability increases, it's a loss. If your liability decreases, it's a gain. Transfer to P&L account. And we have curtailment now. Curtailment means reduction in benefit. Curtailment word itself means reduction. In this standard, curtailment means reduction in benefit. So curtailment when occur when entity either commits to reduce the number of employees covered by the plan. One is number of employees who are covered by the plan, they are reduced. They will say out of 150 now only 100 are eligible for some reason. Or second is they may reduce the benefit. They may reduce the benefit under the plan. Okay. Like it happens, companies have to shut down some operation or some department. So some employees of that division or department may not be eligible, and therefore the benefits will have to be curtailed. The benefits will have to be reduced. It is called curtailment. And the treatment is, I have written here treatment, gain or loss on settlement or curtailment will be recognized when the settlement or curtailment occurs. So P&L account, in bracket, any gain or loss on curtailment or settlement will be recognized immediately in profit and loss account. Okay. So how to compute the gain or loss on curtailment? How to compute the gain or loss on curtailment? Suppose there is a reduction in liability. Usually there will be a reduction in liability because some employees are not covered or covered with lower benefit. Less asset distributed to curtail minus any asset or amount paid to curtail. So this is your reduction in liability. This is reduction in asset. You have to pay some amount, if any. Deduct that. The difference is gain or loss on curtailment. If reduction in liability is more than the asset distributed, it is a gain. All of you know, if liability is reduced is more than reduction in asset, it is a gain. If liability reduces is less than reduction in asset, then it is a loss. Then it is a loss. If I have to settle a liability of 100 by paying 50, it's a gain for me. But if to settle a liability of 50, if I have to pay 60 rupees, then 10 rupees my loss. So that gain or loss on curtailment will be transferred to profit and loss account. So we'll take few questions on this. Some of these questions have been given in the study material, were asked in the previous exam, or taken from reference book. Okay, so this question is from reference book, question number 20, and question number 21 is from study material, but it was also asked in the exam. 21 was asked in the exam also. Question 20, an enterprise discontinues a business segment. Discontinues a business segment means now they are not going to operate that segment, and what will happen because of that? And the employee of this segment will earn no further benefit. So those who are the employees of this segment, they are not entitled to further benefit. So this is curtailment. Business segment is discontinued, employees will not be entitled for further benefit. This is curtailment, but without settlement. There was no settlement, only the benefits are now removed immediately before the curtailment. Now see the figures appearing in your books, in your balance sheet. You have a liability appearing in the balance sheet 1000 rupees. You have fair value of plan asset appearing in balance sheet 820, and you have unrecognized past service cost, that is deferred past service cost. Past service cost not yet recognized in P&L account is appearing in the books 50. The curtailment reduces the obligation to rupees 900. So this liability is reduced from 1000 to 900, and this unrecognized past service cost from 50 to 45. Now you should know, liability has a credit balance, asset has a debit balance, deferred past service account also has a debit balance. Okay, so now my question is, suggest the accounting treatment. Oh, the answer is not printed. You will have to write. So write down, my liability I will reduce from 1000 to 900. What do I do? If I have to reduce the liability from 1000 to 900, I will debit the liability. And this unrecognized past service cost, which has a debit balance, I have to reduce from 50 to 45. I have to write off 5. So what I'll do? I'll credit. So liability debit 100. Deferred past service cost will be credited by 5. And the difference will go to P&L account. And the difference is the gain or loss transferred to P&L account. So my dear learned students, please write down, computation of gain or loss on curtailment. Computation of gain or loss on curtailment. Right hand side rupees. First write down point A. Resulting change in liability. Resulting change in liability. Liability was 1000, now it is 900. Hundred profit. Then write down resulting change in URPSC. Resulting change in URPSC. Five. So gain on curtailment will be 95. Profit, you can see 100 profit, 5 loss, net profit 95. And suppose you have to pass journal entry. Liability account, debit 100. To unrecognized past service cost, 5. To profit and loss account, 95. To profit and loss account, 95. To profit and loss account, 95. So this is the entry. One more practice will do. The problem which was given in the study material and which have been asked in the exam also. See the size of the question. The institute can do anything, okay, with you. So you will now Rockstar Limited discontinues a business segment. Rockstar discontinues a business segment. Same question, but they are asked in a more detailed manner. Only they have created a background. Under the agreement with employees union, employees of the discontinued segment will earn no further profit. This is a curtailment without settlement. This was written in the previous problem also, because employees will continue to receive benefit for service rendered before discontinuation of the business segment. Curtailment reduces the gross obligation for various reasons. Now they are giving you reason why the liability reduces, although not relevant in solving the problem, but for understanding the concept it is a good line. Curtailment reduces the gross obligation for various reasons, including change in actuarial assumption made before curtailment. If the benefits are determined based on last pay drawn by the employees, because now the calculation will change completely. As they are discontinuing the operation, the last pay that they had earlier assumed is no longer valid, because the employee is not going to get the payment. The gross obligation reduces after the curtailment because the last pay earlier assumed is no longer valid. So earlier you might have thought employee will serve 30 years of service, but now after 20 years that department is closed. So the last pay which was used for estimating your liability is no longer valid. Therefore you have to revise your liability. Rockstar Limited estimate the share of unamortized service cost that relates to part of the obligation at 18 rupees. So unamortized service cost will reduce by 18, like the previous problem. calculate the gain from curtailment and liability after curtailment to be recognized in the balance sheet of Rockstar on the basis of the information given. So we are solving a very important question number 21. Source is study material, also past exam. Some details are given. Immediately before the curtailment, gross obligation is estimated at 6,000 based on actuarial assumption. So your liability before curtailment is 6,000. Fair value of the plan asset before curtailment is 5,100. Unamortized past service cost is 180, similar to previous question. Previous question is given in the form of a table, and now it says curtailment reduces the obligation by 600. Why 600? 6,000 into 10%, which is 10% of the gross obligation, which is 10% of the gross obligation. So my question is, what is the gain or loss on curtailment? Like the previous problem, you will just write 3 lines. Liability reduced by 600. Nothing happened to the plan asset, so don't disturb it. Minus your deferred past service cost will reduce by 18. So net gain will be 582. Net gain will be 582. Second thing, in balance sheet, now the liability will appear 6,000 minus 600, 5400, minus deferred past service cost will appear 180 minus 18, 162, minus plan asset will appear 5,100. Nothing changed in plan asset. So now the revised net liability would be 5400 minus 162 minus 5,100. So the revised liability in the balance sheet would be now 138. So this is the answer. Okay, so the answer I have given in the book. Let us tick the right answer, tick the answer. As per the question, answer is smaller than the question. Reduction in gross obligation 600, less proportion of unamortized past service cost 18. Both figures are right in bracket given in the problem. No calculation required. So gain from curtailment is 582, and the liability will get revised in the balance sheet. So now your liability will be 5400 minus fair value of plan asset 5100 minus unamortized past service cost 162, and therefore the liability in the balance sheet 138. One more thing I will give you for your benefit. If they ask you past journal entry, please write past journal entry. So we are going to write present value of defined benefit obligation account debit 600 to unrecognized past service cost 18 to P&L account 582 being gain on curtailment. Please write down. If they ask you journal entry also along with this question, then you can write being gain on curtailment recognized. There was no use of plan asset to settle the liability or settle the curtailment. So plan asset will not change. Plan asset will not change because plan asset was not used in the whole process. Next paragraph is actuarial assumption. As we have discussed earlier, I will not take much time on this. Actuarial assumption means assumptions made by the actuary for the purpose of calculating the liability. And I think in the previous lecture we have discussed there are two types of assumptions: demographic assumption, financial assumption. Assumption made by actuary should be unbiased, already discussed in the previous lecture. You can revise. And it should be mutually compatible. They are an enterprise based estimate. Because it requires estimation, the estimation has to be the best estimate, because it can't be simply guesswork. You need to take the help of an expert called actuary. They are an enterprise based estimate of the variable that will determine the ultimate cost of providing post employment benefit. Employee will join today. Employee will retire after 30 years. You have to record the cost, you have to record the liability. So it has to be based on the best estimate. They should not be imprudent, or they should not be excessively conservative also. That means the liability should not be very high or should not be very low, because it will affect your profit and loss account and balance sheet. While making estimation, it should reflect the economic relationship between factors like inflation, salary, return on plan asset, discount rate, etc. There are two types of assumptions. Already explained, I am not going into detail again. Refer the previous lecture. Demographic assumption and financial assumptions. Demographic assumption will deal with items like mortality. Mortality means death. Some employees may die. So that you have to estimate. Turnover of employees, how many employees will leave. Disability, somebody may meet with accident. Early retirement, all these assumptions have to be made so that you can have a proper estimate of liability, and the proportion of plan members with dependents will be eligible for benefit. Some companies also give benefits to the dependents. And the next is claim rate under medical plan, that is medical benefits provided to the employee. How many of them will claim and how much they will claim will all have to be estimated. And financial assumptions are discount rate, salary increase, medical benefit, future medical cost, expected return on plan asset, like this. As a student, for this part you have to only remember what are the financial assumptions, what are the demographic assumption, okay, what care should be taken while making the assumptions. Assumptions should be unbiased, mutually compatible, neither excessive conservative nor imprudent. Okay, while making financial assumption, what care you have to take? Financial assumption should be based on market expectation. That is what the market perceives, how the market believes about salary growth rate, about inflation, about expected return on plan asset. And discount rate and other financial assumptions should not be inflation adjusted. Discount rate and other financial assumptions should not be inflation adjusted unless such measures are more reliable. Unless such measures are more reliable, no need to compute or consider inflation in the discount rate. Now the next question is, what is actuarial gain or loss? Actuary is not a god. Actuary is only expert in making estimation about the future liability, future employee turnover, future medical cost, etc. But there are two types of gain or loss. due to actuarial assumption. One is called experience adjustment. Adjustment means difference between what is assumed and what actually occurred. So actual versus estimated, that is called experience adjustment. And the second type of actuarial gain or loss is due to change in actuarial assumption. If you change the assumption, the liability will increase or decrease. What about the treatment? The treatment is transfer the gain or loss to P&L account immediately. No need to defer. Any actuarial gain or loss will be transferred to profit and loss account. Okay. Now there is a question from study material on actuarial gain and loss. So we'll take this also immediately. Question number 22. Because it's from study material, I can mark it as important. Question number 22. Omega Limited belongs to the engineering industry. The company received an actuarial valuation for the first time for its pension scheme, which revealed a surplus of rupees 6 lakh. It wants to spread the same over the next 2 years by reducing the annual contribution to 2 lakh instead of 5 lakh. It wants to spread the same over the next 2 years by reducing the annual contribution to 2 lakh instead of 5 lakh. The average remaining life of the employee is estimated to be 6 years. You are required to advise the company on the following items from the viewpoint of finalization of account, taking note of the mandatory accounting standard. Now they have done the actuarial valuation and it revealed a surplus of 6 lakh. Okay. So the answer is it should be immediately transferred to P&L account. It should be immediately transferred to profit and loss account. It should be immediately transferred to P&L account. The company's policy to spread it over the next 2 years is not justified. Okay, as per AS 15, any actuarial gain or any actuarial loss will be immediately recognized in profit and loss account. Is it right? So today we'll stop here. Thank you very much.